The start of 2026 was a dream come true for precious metals investors, as the markets delivered gains that few had dared to imagine just months before. Gold and silver weren't just rising, they were exploding to record highs, sending shockwaves through financial markets and capturing headlines worldwide. Gold, the classic safe haven, shattered the $4,000 per ounce mark in October 2025 and kept climbing, fueled by global tensions, central bank buying, and a growing sense of economic uncertainty. But silver stole the show, surging an astonishing 68% in January alone, its best month since 1979, and a move that left even seasoned traders stunned. Silver's rally was powered by two unstoppable forces: safe haven demand from investors seeking shelter from market storms, and booming industrial use, especially for electric vehicles and solar panels, as the world raced toward cleaner energy and electrification. With supply deficits mounting and inventories shrinking, silver quickly became the market's darling, attracting attention from all corners of the globe. Retail investors piled in, drawn by silver's lower price compared to gold, hoping to catch the next big wave and secure their piece of the action. Social media buzzed with FOMO, as stories of overnight fortunes and wild price predictions went viral, fueling even more excitement. Trading volumes in silver ETFs skyrocketed, especially in places like Australia, where investors scrambled to get exposure to the surging metal. Gold peaked just under $5,600 an ounce, while silver soared past $121, both smashing previous all-time highs and rewriting the record books. Analysts declared a new era for precious metals, with prices seemingly unstoppable and optimism running at fever pitch across the industry. The market felt invincible, until it wasn't. Euphoria was everywhere, but so was risk. History warns that parabolic rallies are fragile and that what goes up so quickly can just as easily come crashing down. The higher and faster they rise, the more vulnerable they become, as volatility and uncertainty creep back into the picture. The stage was set for a dramatic reversal, and investors everywhere braced for what would come next. The crash's trigger came from outside the metals market. First, a tech sell-off hit when Microsoft reported slowing AI growth, sending shockwaves through Wall Street. Tech giants tumbled, sparking fears that the AI bubble was bursting. Then, news broke that President Trump would nominate Kevin Warsh, a known inflation hawk, as Fed chair. Markets braced for higher interest rates and a stronger dollar. Investors rushed to sell metals to cover tech losses and lock in profits. Automated stop losses and vanishing liquidity turned a correction into a rout. The metals market, once unstoppable, was now in freefall. A perfect storm had arrived. The crash was swift and brutal, catching even seasoned traders off guard. In a matter of minutes, the market's mood shifted from cautious optimism to outright chaos, as screens everywhere lit up with a sea of red. Gold plunged nearly $500 in just a few hours, erasing weeks of hard-fought gains and wiping out an astonishing $3.4 trillion in global value. The precious metal, long considered a safe haven, was suddenly anything but. Silver, even more volatile, crashed from $121 to $107 on Thursday, then plummeted further to $75 on Friday, marking a staggering 35% collapse in just 2 days. The speed of the drop left investors reeling. Platinum and palladium were also hammered, each falling over 20% as the sell-off spread across the entire precious metal sector, leaving no asset untouched. Panic replaced euphoria almost instantly, as fundamentals gave way to raw fear and uncertainty. The trading floors became scenes of confusion and disbelief. Retail investors, many of whom had bought near the top, faced devastating losses. For some, years of savings vanished in a single trading session, leaving them stunned and anxious. Social media went silent as optimism was replaced by despair. Online communities that once buzzed with excitement now echoed with disbelief and regret. The safe haven myth was shattered in just 48 hours, as even the most trusted assets proved vulnerable to the storm. The metal's boom ended, not with a whimper, but with a spectacular implosion that sent shockwaves through the financial world. The fallout was just beginning, and the true impact of the crash would take weeks, if not months, to fully unfold. The metal's crash sent shockwaves through global markets, triggering a chain reaction that few had anticipated. Investors and analysts watched in disbelief as the effects rippled far beyond the commodities sector. U.S. stocks, already shaken by tech losses and recent volatility, fell further. The Nasdaq and S&P 500 both dropped sharply, deepening concerns about the broader economy. The U.S. dollar surged as investors sought safety in cash, putting even more pressure on commodities and emerging markets, which struggled to keep up. Oil prices retreated, and volatility spiked across asset classes, with energy and raw materials especially hard hit by the sudden shift in sentiment. Interestingly, Bitcoin held steady around $83,000, defying the chaos. Some speculated that capital might flow back into crypto as investors searched for alternatives. The crash exposed the dangers of momentum trading and hype-driven rallies, reminding everyone how quickly fortunes can reverse in modern markets. Investors everywhere were forced to reassess risk, reconsidering their strategies and questioning assumptions that once seemed unshakable. The interconnectedness of markets was undeniable, as shocks in one sector quickly spread to others, highlighting the fragility of the global financial system. Confidence was shaken, and the mood turned from greed to caution, with fear and uncertainty replacing the optimism of previous months. The era of easy gains was over, and a new reality was setting in for investors around the world. The gold and silver crash of January 2026 is a cautionary tale. Parabolic rallies, driven by hype and FOMO, are fragile and often end in pain. The crash showed how quickly sentiment can shift, especially when macro factors like Fed policy change. Silver's dual role, as industrial metal and monetary asset, made it especially volatile. Investors learned the hard way that risk management is crucial. The market now faces a period of uncertainty and reassessment. Some see a buying opportunity, others remain wary. The next chapter will be written by fundamentals, not frenzy.